Hi everyone, Joel Carty from Solace Financial. Welcome back for our monthly update for April. April was a big month for markets, a mix of geopolitical tensions, inflation concerns, and surprising strong investor optimism. Let's break it down to what happened and what it means and what we're watching next. April kicked off with markets recovering strongly after a sharp sell-off we saw in March. The key driver, the ongoing US-Iranian conflict. We saw a fragile ceasefire early in the month, which briefly calmed markets, but tensions never fully disappeared. The Strait of Hormuz, a crucial oil shipping route, reopened and then faced restrictions again. The result, oil prices were all over the place. We saw oil drop to around $100 a barrel before surging back up to nearly $126 a barrel by the end of April. So volatility was the theme. Despite all that uncertainty, global share markets actually had a very strong rebound. The US market rose over 10%, emerging markets jumped nearly 15%, and global markets overall were up close to 10%. Investors basically said, yes, there's short-term noise, but the long-term outlook still looks solid. What supported this? Strong corporate earnings, continued investment in AI, and optimism that geopolitical tensions might ease. Now, Australia didn't keep up with global markets. The ASX rose modestly, only about 2.3%, recovering just part of March's losses. So why the underperformance? Well, it resulted from an Australian dollar being so strong, higher oil prices, which hit local businesses harder, and expectations that the RBA may continue to hold rates higher for longer. Within the market, resource companies did fairly well, but banks and consumer stocks struggled. Interestingly, small caps bounced back stronger than large caps, driven in the tech and defense sectors. Oil was the big macro story. Higher energy prices fed straight into inflation. In the US, inflation hit its fastest pace since 2022, and in Australia, inflation is still above the RBA's target. So what did central banks do? They paused interest rates. The Fed, the European Central Bank, and the Bank of England held rates steady. But importantly, they're still cautious. They're worried about inflation, especially energy-driven inflation. And this could stick around longer than expected. In currency and bonds, a couple of important moves happened. The Australian dollar strengthened, getting close to 72 US cents. That's partly due to a relatively high interest rate expectation in Australia. Bond markets were pretty steady overall, but the key takeaway is this. Markets are no longer expecting interest rate cuts anytime soon. In fact, there's even more talk of future rate hikes if inflation doesn't ease. Other key moves, gold was relatively flat, holding steady but below earlier highs. AI stocks remain the major theme, but we saw some volatility late in the month. Investors are now asking which companies are actually making money from AI. So what are we watching next? Looking ahead, there are three big themes to monitor. One being the Middle East situation. This is still the biggest short-term risk. If tensions escalate again, oil prices could spike, which could impact inflation and global growth. Inflation and interest rates. Central banks are walking a tightrope. Inflation is still too high, but raising rates further could risk slowing the economy. So we expect some continued uncertainty here. The AI investment boom. This is still one of the biggest long-term drivers in the marketplace. Investment in AI is supporting productivity, earnings growth, and market confidence. The AI investment boom. This is still one of the strongest long-term drivers in the market. Investors are still supporting it because it's resulting in better productivity, earnings growth, and market confidence. But investors are becoming more selective. Not all companies are going to benefit equally. So what does this all mean? Markets are looking past short-term risks, but volatility is still very much here. We're in a period where geopolitics matter, inflation still matters, and importantly, diversification matters more than ever. At Solace, we're continuing to focus on building portfolios that can adapt, not just react. If you've got any questions about how this affects your portfolio, feel free to reach out. And always, stay invested, stay disciplined, and we'll see you next month.